Welcome back. You're watching us here on Chartbusters. The company on our radar right now is a new kid on the block, Ajax Engineering, a leading, self-loading concrete mixer company. We have with us Subrata Saha, who's the managing director of the company, joining in. They're near 1,700 crore IPO, which was an entire offer for sale, has listed, and in line with the market, it's lower by about 6-7% itself. We have with us the CFO and the managing director of the company. Let's go across to Tuhin, who is the CFO. Tuhin, I'm looking at your performance. The revenue growth for the last 3 years has been compounding at over 50%, though the first half of this year has been just 12%. Understandable, because there was some slowdown in the industry. There were major elections, etc. as well. So the street has factored that in. The question is, what now from here? At what pace can you grow in the second half of this year? And more importantly, the next couple of years? Do you return to that historic CAGR of 51%?
Thanks, and good morning to you and your viewers. I think the 50% has to be in a context. If we look at Ajax's decadal growth, which is from 2014 to 24, we grew at about 18%. The 50% which you see in the last 2 years compounding, that was on the reset which happened during the COVID times, and as you would understand that the construction industry and associated went to a downward, let's say, trajectory in terms of the demand. And when the demand picked up, that's where the 50% growth comes from. So you asked the question that, where do we see the company in terms of growth going forward? We have given guidance that, we'll be in the range of, again, the same 15 to 18% growth as we move forward, which is akin to a decadal growth performance of the company. If I look at the first half, I think, you guys follow the market, the construction equipment and the cement, of course, was a downturn. There was a prolonged monsoon, and hence you see the 12% growth. This should also settle more in the ranges which I previously spoke about when the full year pans out for us.
So 18 to 19% is more like it from a sustainable basis?
That's correct. That's correct.
Okay. All right. Hi, Mrs. Saha as well as Mr. Basu, and welcome to the show. Not the most optimistic time to list on the exchanges, but businesses that do well will ultimately find their value. So let's get straight to it. Even though growth has been a little bit slower, but gross margins have improved. Could you tell us, how does this happen? Where does gross margin stabilize at? And what does it mean in terms of EBITDA margins?
So on the gross margin, I think, we will be stabilizing more in the range of, let's say, anything between 27 to about 28, 29%. This is the range we will be in. It, of course, depends on the kind of SKUs which you sell, and there is a variability which comes with it. But that's the range, and that's the pattern which we have seen in the last 2 years, and even, let's say, what we are going to see by end of this fiscal. And the EBITDA margin also will follow. I think if you look at the last 3 years, we have swung it by 390 basis points. That was because of the volume surge which we spoke about. But now, given that it would be more in the range of, let's say, long-term averages of revenue growth, we would expect that the EBITDA margin also settles in the range of 15 to 16% on a go-forward basis.
All right, 18 to 19% revenue growth, EBITDA margins at around 15 to 16% sustainably. Before we let you go, let's go across to Mr. Saha as well. The final question, Mr. Saha, the street looks at your operating cash flow. First 6 months, they were negative on account of things mentioned earlier as well. If you could give us a sense of by when do you turn operating cash flow positive, and what is the likely working capital days which is sustainable for a business like yours?
I think, thanks for having us, and good morning to all your viewers. I think Ajax as a company has an asset-light, lean business model, and if you look at the EBITDA to cash conversion, it's upwards of 70%. And this is a small blip because we needed to build up inventory on account of the transition of emission norms. And we believe that this transition of emission norms will be a short-term scenario from a turnaround in terms of the cash flows. We would want to believe that the strength in the company's operating model will continue to happen, and as we move forward, you will see a very strong comeback in terms of the same.
By when? And what is the number that we're looking at in terms of working capital days?
So working capital days on a consistent basis will be in the range of about 40-45 days.
Okay, all right, gentlemen, appreciate you joining in and filling us in with all of those details. We'll hold you to these numbers and we look forward to interacting with you as your listing journey continues.